Bitcoin halving process. Today, we're taking a deep dive into the intriguing world of Bitcoin halving events and their influence on transaction confirmation times. Certainly, let's get into it. Imagine, if you will, the Bitcoin halving as an epic event in the cryptocurrency world. It's a bit like the Olympics for Bitcoin. It only comes around once every 4 years, or to be exact, after every 210,000 blocks are mined. But this isn't just any event. It's a carefully orchestrated process designed by Bitcoin's mysterious creator, Satoshi Nakamoto. The goal: to control Bitcoin's inflation by gradually slowing down the rate at which new Bitcoins are introduced into the market. Picture this: when Bitcoin first launched, miners were rewarded with a whopping 50 Bitcoins for every block they successfully added to the blockchain. But as you may know, Bitcoin is unique because it has a finite supply. Only 21 million Bitcoins will ever exist. This scarcity is what gives Bitcoin its value, much like how gold is valuable because there's only so much of it on Earth. Satoshi knew this, and to ensure Bitcoin's scarcity, the halving event was built into Bitcoin's very code. So, what exactly happens during a halving? Well, as the name suggests, the reward that miners receive for mining new blocks is cut in half. If you think about it, it's like digging for gold, and suddenly, the amount of gold you find in each treasure chest is reduced by 50%. The first halving, which occurred in 2012, reduced the reward from 50 Bitcoins per block to 25. Then, in 2016, it was halved again to 12.5, and after the most recent halving in April 2024, the reward stands at just 6.25 Bitcoins per block. The next halving is expected in 2028, where the reward will drop further to 3.125 Bitcoins. Now, you might be wondering, why does this matter? Well, the halving event is one of the key drivers behind Bitcoin's price. As the reward for mining decreases, the rate at which new Bitcoins enter circulation also slows down, making Bitcoin increasingly scarce. In theory, this scarcity should drive up Bitcoin's price, as there are fewer new Bitcoins being produced and demand remains strong. It's basic economics. When supply goes down and demand stays the same, prices tend to rise. But the impact of halving extends beyond just price. It also significantly affects the miners who secure the Bitcoin network. With each halving, miners receive fewer Bitcoins for their efforts. This reduction in rewards means that miners must rely more on transaction fees to stay profitable. In the early days, transaction fees were relatively low, and miners could make a good profit from block rewards alone. But as the block rewards decrease, transaction fees become a much more important part of miners' income. The impact of halving on miners and transaction fees. So, what are these transaction fees, and how do they work? When you send a Bitcoin transaction, you can choose to include a fee. This fee is paid to the miners who process your transaction and add it to the blockchain. The higher the fee you offer, the more likely your transaction will be processed quickly, as miners tend to prioritize transactions with higher fees. This is particularly important after a halving, as miners are looking for ways to make up for the reduced block rewards. It's like trying to get a cab in a busy city. You tip the driver extra, and they'll get you to your destination faster. After a halving, we often see a shift in the way miners operate. They start to prioritize transactions with higher fees, which can lead to longer wait times for transactions with lower fees. This creates a competitive environment where users who want their transactions confirmed quickly need to pay more in fees. The average transaction fee can fluctuate based on network activity. During times of high demand, such as a bull market where everyone is trying to buy or sell Bitcoin, fees can skyrocket. Conversely, during quieter periods, fees tend to be lower. It's all about supply and demand. When the network is busy, fees go up, and when it's quiet, they go down. Managing Bitcoin network congestion post-halving. But that's not the whole story. The Bitcoin network is designed with some clever features that help keep things running smoothly, even in the face of halving events. One of these features is the mining difficulty adjustment. The Bitcoin network automatically adjusts the difficulty of mining roughly every 2 weeks to ensure that new blocks are added to the blockchain at a steady rate, regardless of how many miners are participating. If a lot of miners leave the network because it's no longer profitable for them, the difficulty decreases, making it easier for the remaining miners to find new blocks. This helps maintain a consistent block time of about 10 minutes, even as the network adapts to changes in miner participation. Let's delve a bit deeper into how this works. Mining difficulty is essentially a measure of how hard it is to find the right hash, a unique identifier for each block that allows a new block to be added to the blockchain. This difficulty is adjusted based on the total computational power of the network, also known as the hash rate. If the hash rate increases, the difficulty increases, making it harder to mine new blocks. This ensures that blocks are added to the blockchain at a consistent rate, regardless of how many miners are actively participating. This difficulty adjustment is crucial after a halving, as it helps stabilize the network. If many miners decide to shut down their operations because the reduced block rewards no longer cover their costs, the hash rate could drop significantly. Without a difficulty adjustment, this would lead to longer block times and slower transaction confirmations. However, because the network adjusts the difficulty downward in response to a drop in hash rate, it ensures that blocks continue to be added at a steady pace, even if there are fewer miners. But that's not all. There are also Layer 2 solutions, like the Lightning Network, that help manage the load on the Bitcoin blockchain. The Lightning Network is a second-layer protocol that operates on top of the Bitcoin blockchain. It allows for faster and cheaper transactions by moving most of the transaction data off-chain. In simple terms, it's like creating a private channel between two users where they can transact back and forth without needing to record each transaction on the blockchain. Only the final result of these transactions is recorded on the blockchain, reducing congestion and helping keep transaction fees low. The Lightning Network is particularly useful during times of high network activity, such as after a halving when transaction fees tend to increase. By enabling quicker and more cost-effective transactions, the Lightning Network helps alleviate some of the pressure on the main Bitcoin blockchain, ensuring that users can continue to transact smoothly even during periods of high demand. So, what happens to transaction confirmation times after a halving? In theory, if a significant number of miners leave the network because of reduced profitability, the network's total hash rate could drop, leading to longer confirmation times. However, in practice, Bitcoin's built-in difficulty adjustment and the adoption of Layer 2 solutions like the Lightning Network have helped mitigate these effects. While there might be some short-term fluctuations in confirmation times immediately following a halving, the network tends to stabilize fairly quickly. Several other factors also influence transaction confirmation times. Network traffic is a big one. During periods of high activity, such as when there's a lot of speculative trading, the network can become congested, leading to longer confirmation times. Transaction fees are another critical factor. Miners prioritize transactions with higher fees, so users who are willing to pay more can get their transactions confirmed faster. Block size is another important consideration. Bitcoin's block size is capped at 4 million weight units, or roughly 4 megabytes. This limit on block size means that only a certain number of transactions can be included in each block, which can lead to delays during times of high demand. And let's not forget about scalability. As the Bitcoin network grows, scalability solutions like the Lightning Network become increasingly important. These solutions help increase the network's capacity, reducing congestion and speeding up transaction confirmation times. By moving most of the transaction data off-chain, these solutions help keep the Bitcoin network running smoothly, even as more users and transactions are added. Looking ahead, the next Bitcoin halving is expected to take place in 2028. This event will further reduce the rate at which new Bitcoins are created, cutting the block reward down to just 3.125 Bitcoins. As we've seen with previous halvings, this reduction in rewards will likely lead to increased reliance on transaction fees and could result in higher fees and longer confirmation times for users. However, with continued advancements in technology and the adoption of Layer 2 solutions, the Bitcoin network is well equipped to handle these changes. For miners, the 2028 halving will present new challenges. As block rewards continue to decrease, miners will need to find ways to stay profitable. This might involve upgrading their hardware to more efficient models, optimizing their software to reduce costs, and exploring renewable energy sources to cut down on electricity expenses. Staying informed about technological advancements and regulatory changes will be crucial for miners as they navigate the evolving cryptocurrency landscape. It's like keeping your smartphone up to date with the latest software and hardware upgrades to ensure it runs smoothly. For investors, the halving presents both opportunities and risks. On the one hand, the reduced supply of new Bitcoins could drive up prices, making Bitcoin a more valuable asset. On the other hand, increased transaction fees and longer confirmation times could make it more expensive and time-consuming to move Bitcoin around. As always, it's important for investors to stay informed and be prepared to adapt to changes in the market. And that's a wrap for today's deep dive into the world of Bitcoin halving events. If you're passionate about crypto and eager to stay ahead of the curve, make sure to subscribe, hit that notification bell, and drop a comment below with your thoughts.